Welcome back to Renewable Rides. Less than 3% of commercial buildings have on-site solar, and even fewer have on-site energy storage. And the grids that those buildings depend on are running out of slack. Today's highlight episode features Brian Rappaport, Managing Director and Head of Energy Advisory and Distributed Energy at JLL Energy Advisory. Brian brings over 20 years of experience across energy trading, origination, and project development, with stops at Morgan Stanley, BP, and Net Power before landing at one of the world's largest real estate services firms to help solve what is now, unmistakably, a real estate problem. In our conversation with Brian, he breaks down why grid reliability has moved from a utility issue to an asset manager's issue, and how behind-the-meter generation and storage can add millions in asset value at a single property, and why the old landlord-tenant split incentive is finally starting to flip. If you own, operate, or advise on commercial real estate, the grid is no longer your utilities problem. It's yours. Or really better said, it's your opportunity. Let's get into it with Brian.
And Brian, you've kind of seen everything from oil and gas, build out, origination of projects, trading. What attracted you to your role at JLL now?
I think the market has changed so dramatically just in the last few years in real estate, and being someone that's operated in the energy space my entire career, I never would have thought or imagined that I'd be going to work for a global real estate company, doing energy related work. So it's been an interesting ride for myself too. But I'd say why energy and why real estate? Because energy has become a real estate problem. It's not just an operating cost, right? And so you have a convergence of a lot of factors, but three main factors, I'd say, over the last few years that have really compounded the issue and has brought energy at the forefront to real estate discussions. One, our grids are really stressed. We all know that there's the grids are constrained, and that can really be visible and impact asset valuations today at the real estate level. We've got reserve margin compression at our central grids, right, where the independent system operators typically maintain enough slack in the system to deal with emergencies and power plants that trip offline. It's really like a contingency plan. And for the first time, I think ever, forecasts are showing that reserve margins are going to be going below the target reserve margins that these grid operators are planning for, which is a really big thing. So that has a compounding effect, right, for how you get power from the grid, interconnection delays, and of course, energy expenditures, right, utility bills. And that's really starting to show up as we think about cap rates for real estate. And then tenant demand, right? Tenant demand has really shifted. We have large occupiers, industrial plants, we have life sciences, logistics, tech, of course, and they are now including energy reliability and decarbonization commitments in their lease requirements. So that's really important. So it's really not, it's a leasing risk issue, not just an ESG issue. And then I'd say our clients are really asking, these are conversations that wouldn't have happened 5 years ago for a real estate company. But now more than ever, we're getting more and more clients, whether they're occupiers or whether they're investors, asking us for support and help in the space.
Yeah, you really resonates. I mean, that's exactly how we're seeing the folks that we're working with, and super excited to develop the relationship together. Let's before we dig in and spend most of the conversation around the distributed and on-site piece, can you share with our listeners what is the breadth of offerings that JLL Energy Advisory has? Because I know that there's many different facets of it.
Sure. So the Energy Advisory team was born out of our sustainability consulting organizations earlier last year. And we have about 45 people across technical and commercial functions. You can think of it at a high level. We really we serve as an owner's rep to our clients. You can think of us as a trusted advisor working for our clients, acting in a fiduciary capacity to help them design, assess, and implement solutions that address energy risk. So at a high level, our energy systems are really complex, as we said before. That's what I love about it. But a lot of people that aren't in this space just aren't really. They don't know what they don't know what they don't know. And so today, now more than ever, our team is really spending a lot of time with our clients, helping them plan and helping them figure out how to navigate and manage these risks. And it can be quite significant. As far as taking it down to the more granular level and thinking about what are some of the specific services and things that we do for our clients, we do everything from on the front end, energy procurement and rate optimization, as a foundation service for our clients. That's sourcing, from sourcing competitive retail supply and evaluating rate tariffs from utilities to optimizing time of use or providing peak shaving services to reduce demand during high peak hours of the day, to participating in demand response programs. We work with our clients on their decarbonization and scope emission reduction programs. So we work across our corporate and industrial real estate client base, and we help them procure renewables. So that could be long-term strategic procurement programs where we try to aggregate demand across on a portfolio-wide basis to get our clients involved in getting access to low carbon renewable supply sources and provide risk management, long-term risk management tools as well. If things could be done on site, which is where it gets really interesting and exciting, and this is where we can work with VECKTA very closely here. We have a big practice that does distributed energy resource advisory and implementation for our clients. So that's a big part of our business where we've operated in the past and we're continuing to scale up. And that's behind the meter solar, behind the meter generation, potentially paired with energy storage, where we work with our clients to assess feasibility of on-site resources, to doing real detailed financial modeling, developer EPC selections. We go to market for our clients, and we serve as an owner's rep through deployment too. Really, at the end of the day, helping our clients de-risk project execution and allow our clients to get the best terms, conditions, and projects that meet their objectives and make the most impact. And this is where VECKTA really can supercharge us. I'm excited to dig into that. Other areas that we spend a lot of time and effort: grid services and market participation. So again, how we help our clients reduce energy costs through demand response programs, capacity market enrollment. And then once you initiate and deploy on-site energy resources, helping them manage and optimize those resources most effectively so they operate and create the value that they were intended to do on the front end. And then last, I'd say we do a lot of strategic energy intelligence. So that's providing, forecasts, providing, detailed assessment across portfolios, big institutional real estate portfolios, evaluating where clients might be most exposed, where the grids are most constrained, where the grid is the highest, where there's a lot of volatility. But I'd say the most important thing, and I think you guys can attest to this, one thing about JLL, we are technology and solutions agnostic. So we don't have a particular horse in the game. We're not pushing one solution over another. We try to maintain an unbiased approach to understand our clients' needs and work across a host of different solutions and technologies.
Absolutely, and I think that's where the relationship can really shine, because that's exactly a part of our ethos as well. Well, we're very excited. I mean, today this is launching on the day of our collaboration announcement, and so maybe you can share with the listeners, what are you seeing as it relates specifically to on-site energy, that there might be differences across the landlords, tenants, and owner-occupiers? Because as you've started to talk about it, this is a new asset class when we think about the landlords, but how are you seeing the differences amongst those kind of three categories?
That's a great question. And I know we've been having a lot of those conversations too amongst the teams. I'd say, there are meaningfully different categories across our client base, right? When you take it down sector, like industrial sector aside, we have clients that are institutional owners and investors, and that's a big part of our business, right? Where the opportunity is asset value creation through tenant retention and NOI enhancement, right? I was reading the other day, JLL research showed that less than, believe it or not, 3% of commercial buildings have solar. And as you can imagine, even less have energy storage. So that is a huge untapped market opportunity. And when you think about the real estate sector in general, the built environment accounts for like 40% of our global emissions and 40% of energy demand. So there's a significant untapped value and infrastructure to leverage there, whether it's rooftops, adjacent land, parking structures that can generate cash flow for investors of real estate. Then we go to tenants, right? You have tenants and corporate occupiers, and the primary focus there is driving cost certainty and meeting ESG commitments. And so they want supply stability, or they may need more power for growth, right? For low growth and expansion, and they want that carbon reduction without capital expenditures, which gets interesting, right? So we think about what's the best way you can help them achieve those goals, and then I'd say the last category is owner-occupiers. Owner-occupiers is probably the cleanest as far as decision maker, full control of the value stack. The main barrier there is just internal capital allocation, right? So, an on-site energy project may compete against a core business investment. So really it's our job to make energy return on investment legible and understandable at the CFO level, and where it's easy for people to understand and implement, and also think about how these projects can compare to other like extensive capital projects and planning that may not be have an energy component to begin with.
Right, and on that point, I think it's super important, isn't it, where this has always just been a cost input to people's businesses, and it's almost been this just silent line item on the balance sheet or the profit and loss statement that just went up at the rate of escalation, inflation, and they didn't really think too much about it. And you're now describing that this is like actually potentially a revenue generating opportunity, a way to really monetize their assets. How do you help people think through that this isn't just a cost line item, that this is actually, there's a lot more to it?
Yeah, I mean, it's a good question. There's meaningful value creation across a large commercial industrial real estate portfolio. And again, it's getting people to think about the impact that these energy investments can have on real estate cap rates and asset values, instead of just treating it as an operating expense, right? So, like as an example, let's think about this. If you have a hybrid scenario where you have behind the meter solar and battery storage project that might be deployed at a large industrial facility, say it's 500,000 square feet of industrial space, and that on-site energy system can reduce a utility bill by, call it $400,000 a year. Okay, that's quite significant.
Yep.
At a specific cap rate, say it's 5 or 5.5%, you're talking about adding an incremental, $6 to $7 million in asset value just in that decision alone, right? And that's impactful for real estate investors, owners and occupiers of real estate too. And that's really, it goes beyond just an energy saving story, right? It's a valuation story. And so I think that's an important distinction and a model that we want to spend time focusing on with our clients day one, right? Where we really model those project level economics with them. How does it impact real estate cap rates? How does it impact investment returns? How does it how can you commercially implement solutions most effectively, and also how does that stack up against other competing investments like we talked about before?
Certainly. I think we're also, and I'm curious your take on this, moving into an era, like historically there's been the landlord tenant kind of split incentive conundrum where The landlord has the control and they can deploy one of these systems with their capital, but they're not going to receive the benefit of it. The tenant is the one that's going to be benefiting, but they may not make sense for them to deploy their capital into one of these systems. And I think we're starting to see that tipping point of landlords wanting to participate. And for me, the conversations I've had, it's really been around basically paying less to the utilities and almost transitioning some of what your tenant is paying to the utility to you as the landlord. What are you seeing in this kind of the split incentive conundrum, and are you seeing a shift?
I think there's typically, in most situations that we've encountered or starting to encounter with real estate investors, landlords and institutional investors, is the alignment that they have with their tenants. It really comes down to like tenant retention risk and really making sure that landlords or real estate investors share in that value with their tenants, right? And it's important. There are markets that we operate in today that are saturated. You have a lot of supply in those markets, and I think the investors understand that those tenants could potentially go somewhere else quite easily, especially if it's not an advanced manufacturing facility or if it's something that requires a significant upfront investment. And so I think it's an aligned value across the tenant landlord space where you are aligned on cost savings, aligned on resiliency, and aligned on planning for a long-term, strategic value share and relationship that really makes the difference, right? And I think that's where investors could be most impactful is providing those lower cost, higher resilient solutions for their facilities, because ultimately that's going to drive more demand to your facilities.
I like that. It's not only split incentives, it's like actually de-risking your business model, isn't it? Otherwise you can end up with a bunch of stranded assets that you just can't utilize for what they're designed for. And
that's right.
And that's going to be a really interesting transition point, isn't it? Where people go, do we want to go on the offensive, or is this purely a defensive mode?
Then it could be both, right? And so we really spend a lot of time and we try to work with our clients to understand what are those objectives, what are the risks, and then what is the physical infrastructure and the facility, what can it support? And then what are your lease terms? And then the payback of an energy investment, as you know, is typically longer than a lot of lease terms. So how do we navigate the complexities? We really try to distill it down and do it in a way that doesn't need to be complex, and it's not.
We receive a lot of questions from business leaders around the world wanting to learn more about the energy transition, what is possible, and where to start. So to help you stay informed and up to date on best practices, opportunities, risks, and success stories, we created an industry newsfeed at VECKTA.com/news with all our podcasts, blogs, and newsletter. Check it out and connect with Dan, myself, and the VECKTA team to learn more. Cheers and have a good one.